Mark Twain observed a strange paradox. While many understand entirely too little about money, they understand far too much about a lack of it. We still talk about money as if we are trading physical pieces of metal. In reality, the currency in your pocket is an evolving technology. It is a pure system of collective trust. In his analysis of the modern financial system, economist Paul Sheard argues that our understanding of this technology is caught in a thick fog. Many mistake the system for a magical printing press or a moralistic trap designed to enforce debt. To understand why global financial crises happen, we have to look past these metaphors and examine the actual architecture of modern fiat money. We will build this macroeconomic machine from the ground up, starting with commercial credit, moving to sovereign debt, and ending with central bank policy. Moving beyond outdated financial narratives reveals the specific mechanics that drive economic prosperity and lead to systemic collapse. We begin by looking past the printing press myth to a specific axiom. Banks create money, while governments create wealth. The textbook model suggests a central bank prints money for banks to lend. That is false. In modern economies, when a bank issues a loan, it doesn't hand over savings. It creates a brand new deposit on its ledger, generating credit instantly. This mechanism provides the necessary fuel for the economic engine. Without commercial banks expanding credit, businesses cannot scale, and trade slows to a crawl. The risk lies in the allocation of that new money. If banks direct newly created credit toward productive enterprise, the economy grows. If they flood it into speculative assets, they build a bubble. This chart shows U.S. household debt leading up to 2008. Credit creation for speculative real estate drove this to a $12 trillion peak. Lacking a foundation in productive output, the system broke. When the bubble burst, home prices fell 30%. This crisis was centered here, on Wall Street, where institutional incentives encouraged banks to maximize credit creation for asset speculation while ignoring the stability of the underlying borrowers. The 2008 collapse demonstrated that even a functional fiat system requires strict regulatory oversight to prevent credit engines from overheating. This brings us to the second layer of the machine. In a modern economy, the creation of new money is mathematically linked to the creation of new debt. They arrive as a pair. To understand how debt operates on a macro level, we have to distinguish between a currency user and a currency issuer. Households and corporations are currency users. To pay off debt, they must acquire external income. Sovereign governments, however, are currency issuers. This creates a closed feedback loop, where the government has the authority to issue the exact currency it uses to settle its own debts. During an economic contraction, when the private sector stops spending and begins paying down debt, the money supply shrinks. In these moments, sovereign government debt can act as a systemic transfusion, maintaining the flow of credit. This graph compares two recovery paths after 2008. China implemented a 4 trillion RMB stimulus, resulting in the sharp growth curve at the top. The European Union focused on debt reduction and austerity, leading to the stagnation shown in the lower curve. However, a sovereign issuer is still limited by the real-world risk of inflation and the stability of public confidence, forces that are frequently tested during political debates over the U.S. debt ceiling. Mismanaging this tool has consequences. Japan's debt-to-GDP ratio reached 250%, but because the capital was used to subsidize failing enterprises rather than new innovation, the economy entered a 30-year period of stagnation. Debt is a tool. Its macroeconomic impact is determined by whether the capital is directed toward productive capacity or consumed by inefficient entities. At the top of our machine sits the central bank. Contrary to popular myth, central bankers do not have direct, total control over the exact volume of money circulating in the economy. Central banks steer the economy indirectly by adjusting short-term interest rates. By changing the cost of borrowing, they influence the rate at which commercial banks choose to create credit. This lever has technical limits. When the European Central Bank moved interest rates into negative territory, it compressed the profit margins of commercial banks, which actually restricted the lending it was trying to encourage. The limits of this policy are visible in Japan. This chart shows a massive expansion of the monetary base, yet the inflation line remained at 0% for years. This outcome was driven by structural factors like globalization and digital price transparency, which suppressed costs even as the monetary supply expanded. The 2022 U.S. inflation spike provides a contrast. As this chart shows, the 9.1% peak was caused by a massive $1.9 trillion stimulus hitting a world with broken supply chains. When global shipping bottlenecks and energy prices surge, inflation becomes a product of physical constraints that monetary policy alone cannot resolve. Because their direct power is limited, central banks rely on communication. Alan Greenspan famously used intentional ambiguity to maintain market stability. Modern central banks now use forward guidance to provide transparency. However, a small hint of a policy shift, like Ben Bernanke's 2013 comments, can trigger a taper tantrum and erase 10% of market value instantly. The efficacy of monetary policy depends on market psychology and its alignment with government spending. This explains why monetary policy often widens the wealth gap. Central bank liquidity flows primarily to existing asset holders. The data shows this clearly. Between 2010 and 2020, the S&P 500 grew by over 200%, while average wage growth remained flat. To address this, governments can shift toward targeted fiscal policy, directing funds toward infrastructure and education to put capital directly into the productive economy. The underlying technology of money is also evolving. Central bank digital currencies are being developed to improve how economic policy is transmitted. Digital currencies, like the digital RMB, allow central banks to bypass intermediaries and deliver stimulus directly to consumers. This precision targeting also applies to climate change. Through Green QE, central banks tilt asset purchases toward green bonds, funding renewable energy. Finally, the system requires a more balanced global landscape. The current dominance of the US dollar exports volatility to emerging markets, a pressure that could be reduced by a more multipolar currency system. Integrating targeted fiscal policy with digital transmission networks provides a framework to address stagnation while maintaining systemic stability. Moving forward requires us to re-examine the nature of money. Modern economics is not a zero-sum game or a battle over fixed physical resources. Money is a ledger of collective trust. It is the technology we use to coordinate human labor and scale innovation across the globe. This invisible network of trust is what allows thousands of ships to move cargo and millions of businesses to trade every day. Arthur C. Clarke noted that sufficiently advanced technology is indistinguishable from magic. Our credit system appears magical only because its underlying architecture is so complex. Understanding the architecture of credit allows us to navigate boom and bust cycles with the technical precision of engineers, building toward a positive-sum future.